My name is Martina McPherson. I'm the Senior Vice President for Strategic ESG Engagement at Moody's Corporation, and I'm joined by three experts and colleagues today, Anna Zubi Anderson, Kiran Gwilliam Bihari, and Rahul Ghosh, who are leading on the expert views and opinions for this session, and they will introduce themselves in a short while. Meanwhile, I'd like to set the scene and the context for today's discussion and why we are looking at implications of systemic risk and opportunities management in a post-COVID world context. Well, the global COVID-19 outbreak has emerged as a systemic social, health, safety, and security crisis. It threatens the well-being of the world's population, and millions of people around the world are impacted or will be impacted from the resulting downturn and the loss of employment and other opportunities. May I just lead over to the first slide, by the way? Thank you. To build back better at a sovereign and at a multinational level, first of all, we need to focus our efforts on infrastructure, systems, and services that can withstand the pandemic now and in future. And governments are being asked to refocus and adapt their social efforts linked to health, well-being, safety, housing, transportation, and international collaboration. And while science suggests that the speed and impact of this crisis has likely accelerated the onset, or has likely been accelerated by the onset of global warming and the destruction of natural habitat and biodiversity, the interconnectedness of what we call systemic environmental, social, and corporate governance risks and opportunities can be seen across the investment value chain and is impacting global supply chains, and we will hear more of this today. Meanwhile, it has also become clear that there is an upcoming shift and a rethink when we look at sustainability policies, practices, business models, and ultimately investment priorities. There is a pluralism of ESG standards and frameworks that are now being recognized as tools to actually advance progress when and where governance and sustainability are concerned. And they also enable us to integrate ESG into investment decision-making. May I lead over to my next slide? Thank you. In the context of today's discussion, I would also highlight two aspects for further debate later on. One around the SDG framework, the 17 UN Sustainable Development Goals that are referenced as one of the leading ESG frameworks when and where prosperity, growth, inclusion at a sovereign and increasingly at a company and reporting level is concerned. This SDG framework in turn might enable us to better understand the context of a just transition, highlighting the role that organizations and their supply chains can play in providing opportunities related to prosperity, inclusion, and growth. The just transition, by the way, is a framework that's been developed to encompass a range of social interventions that are needed to secure livelihoods when economies are shifting to sustainable production and combating climate change and protecting biodiversity. In the past years, a number of organizations have now deployed this concept, and it has evolved as a push for transition to both environmentally and socially sustainable employment opportunities and economies. So with these few words on some of the concepts we are also trying to explore today, I would like to briefly highlight that in this session, in this webinar, we're aiming to discuss three major topics. One around the coming and upcoming ESG trends, risks and opportunities across Asia Pacific and the post-COVID context. Second, the recommendations to analyze and advance operational resilience in the broader ESG analysis, corporate and supply chain context. And then ultimately recommendations for next steps from a sector and thematic investment perspective and standpoint. So with these few words of introduction, I'm delighted to handing over to the first expert speaker, Anne Zube-Andersen.
Thank you so much, Martina. If we can advance to the next slide, that would be wonderful. Thank you, Martina. So I'm Anna Zube-Andersen. I work for Moody's ESG Solutions Group. Martina and I work very closely together. And thank you, Martina, for doing such a great job of highlighting the key trends. I will speak a little bit more about the trends in ESG and sustainable finance market. And the key point here on the slide that you see here is increasing interest from investors in the topics of ESG. And obviously where we see that showing up is tremendous growth in assets under management, sustainable assets under management, which is here is our investments that are managed in accordance with some kind of strategy that explicitly incorporates environmental, social, and governance factors. You add up the green bars here, which is the latest data point, we see that sustainable assets under management globally now well exceed $30 trillion, which is quite impressive. You can see that while US and Europe are still key markets, we see tremendous growth in other regions of the world, notably in some countries of Asia Pacific. So if we can move forward, please. Thank you. So on this slide, really what I want to highlight is sort of the mirror effect that we see from the corporate, right? So as investors' focus is increasing around ESG and we see growth in sustainable assets under management, obviously there is also an increasing communication from the corporate sector on topics of sustainability and topics of ESG. And this is sort of coincides with some of the recent statements from the Business Roundtable. For example, in 2019, there was a statement where we saw a shift from the shareholder primacy model to more of a stakeholder vision of capitalism that says, you know, all stakeholders matter and the businesses are here to create value for everyone. So it's a real shift in communication strategies to really address the sustainability and corporate social responsibility. One metric we could look at and kind of seeing these communication trends is the prevalence of CSR reports. I mean, CSR, corporate social responsibility reporting, is a common way that companies communicate about ESG and sustainability. And we've seen tremendous growth in prevalence of CSR reporting. You see a graph here at the bottom shows a trend among S&P 500 companies as to how many or the percentage that actually have CSR reports. And up to 90% in 2019. So I think the key carry here is that it's becoming really normal standard business practice to have a conversation about sustainability, ESG, and CSR. Even if we go back, 10 years ago, maybe it was more the best in class, the companies that were on the front lines of sustainability conversation that had CSR reports, but now it's really more of a standard to have one. If we can move on, please. So the key point here, it's a lot on the slide. I don't want to spend too much time on it, but I think the key point that I want everyone to carry away here is in the aftermath of the pandemic, these trends that I just discussed, really, they just intensified, right? It's really, we have even more focus on ESG in the aftermath of COVID-19. I think the main bullet point here is the second one. This is a data point from Morningstar, recent data point. We see that the flows in sustainable funds in the first half of 2020 were almost the same as flow in sustainable funds for all of last year. And that's really quite impressive. It's a tremendous growth. If we can move forward, please. Right, so bringing the focus on Asia Pacific, I spoke a little bit earlier about the fact that the region is sort of the next to experience growth and sustainable assets under management, and we see significant growth rates here. I mean, this coincides with increasing focus from regulators. In general, we think that the robust regulatory framework kind of leads and supports growth in sustainable finance markets, and that's because it helps with investor trust, right? To have frameworks and have regulator attention. And we see across the region from different countries, there is increasing focus on ESG, and that is usually a precursor to further growth in sustainable finance markets. And that's the key point I want to highlight without having to read through all the details. But if we can move forward, please. And to bring focus again on supply chains, since we're going to talk quite a bit about supply chains today, in particular ESG and supply chains. Well, first of all, to just take a step back, what is it that we're talking about when we talk about ESG and supply chains? Again, to take the stakeholder lens to it, it's really about creating value for all the stakeholders in the product life cycle, and considering the needs and interests of all of the stakeholders in the product life cycle, and not just the shareholders. Again, in the aftermath of the pandemic, we've seen increasing focus on these issues. Needless to say, managing stakeholder expectations in a globalized world in supply chains is very complicated. Both environmental factors are important, as well as employee protections and treatment of employees are important. And protections afforded to employees in the environment are obviously, they vary throughout jurisdictions. And that makes managing these risks very complicated, but also, for ESG data providers, ESG assessment providers, ratings providers, it makes it complicated to evaluate them as well. Again, COVID-19 brought further attention to this, in particular health and safety concerns among the workers. So I'm going to touch a little bit on the standards around ESG and supply chains. I don't want to, Kieran is going to speak about it, so I'm not going to spend too much time on it, but I'm going to touch briefly on UN Global Compact standards. Now, obviously, we have a lot of texts from UN that concern human rights, starting with the International Bill of Human Rights. But UN Global Compact in particular are the standards that speak about how corporations can respect human rights in their operations. And UN Global Compact standards kind of provide an overarching principles for how that can be done. So again, not to get too much into the weeds, but some of the key points I want to highlight are, things like respect for, respect for human rights, but right to collective bargaining, no compulsory labor, no child labor, no discrimination in the workplace, those kinds of things. And Kieran is going to speak more about how Vigeo Eiris thinks about this and what standards they use. So with that, I'm going to turn it over to Kieran. Thank you very much.
Thanks very much, Anna. And if we can progress to the next slide, please. So, hi everybody on the line. I'm Kieran Gwilliam Bahari, the Director for Market Access at Vigeo Eiris. We are an affiliate of Moody's, engaged in providing ESG assessments on both corporates, as well as providing data to issuers as well. I want to talk about social risk coming to the fore very quickly, and I won't spend too much time on it because Martina and Anna have already covered it very well in their introduction. So if we can advance to the next slide. Really, 2020 has been a year where social risk has been placed back at the top of the agenda for many corporates and many investors. And as has been said already, COVID-19 has really been a driving factor behind it. Now that's important because as someone who's worked in the industry for some time, when you think about ESG discussions at corporate and investor level, we often talk about the S as being a small s. It's fair to say in recent years, and from 2015 in particular, much of the product innovation and much of the discourse has been around green bonds rather than social bonds, around energy transition and low carbon indices rather than social indices. Even in reporting frameworks, we've seen the TCFDs emerge, but there's no real comparable competitive framework for social reporting as things stand today. And COVID-19 has really dramatically turned that paradigm on its head. In truth, the pandemic has raised a host of issues for corporates to manage or for investors to take into consideration that were already there. It's not been a matter of creating something new, rather than it has been exposing underlying weaknesses in our systems that were already there. And I think it's important to notice or to identify early on that when we talk about social risk, it is a complex beast. There are many, many stakeholders engaged, many stakeholders to target and to manage if you're trying to create a strategy, whether at investment level or at CSR level, to tackle these kinds of issues. So you're talking about The supply chain, yes, employees, consumers, communities, there is a lot there to take in. And so for today, I'm going to focus on supply chains only. So if we can advance to the next slide, I just want to talk a little bit about globalized supply chains, the pros and cons, and our perspectives at VE. So in recent decades, yes, the globalization of supply chains has really served as an engine of growth. It's allowed companies to operate more efficiently, to scale up profits, to reach different corners of the globe they might not otherwise have had access to. But in recent years, a lot of that shine, a lot of that branding, I think, has been damaged, partly as a result of major high-profile ESG controversies, many of which have taken place in the Asia-Pacific region, but also as a result of these disruptions, whether we're talking about the volcanic eruption of a few years ago or COVID-19. They've really drawn attention to what you might call the inherent fragility of globalized supply chains. There are a few elements I would point to when we talk about this, this fragileness, if you like. First is complexity. In a long global supply chain, when something goes wrong, there's often very little slack, and this process of having to reroute or to reorganize is time-consuming and expensive and inefficient. There are issues over visibility, and this is often what we hear when we're analyzing ESG controversies related to supply chains. When something goes wrong, we hear from corporates and we hear from investors that there's very limited visibility over how these supply chain elements are being either overseen, managed, or audited. And so that's often, again, a challenge. And when you combine that notion of complexity and visibility, or a lack of visibility, together, you can really understand how those factors create both operational and reputational risk to companies to manage. Thinking more widely, and I think that Rahul will touch upon this later, the kind of low friction environment that we've enjoyed over the last 50 years plus when it comes to globalized supply chains, that's definitely something that's coming under threat from a mix of populist policy actions, the threat of tariffs, the fragmentation of trade blocs. So in another dimension away from sustainability, there are other things to bear in mind. Now, Anna mentioned the Global Compact, and it's important to talk about standards for how we expect corporates to be operating when it comes to supply chain management. And certainly the UN Global Compact, which has many members in the Asia-Pacific region, which is still rising, that really does set a great fundamental baseline for what the expectations are for companies. There's a lot of material about supply chain management integrated into the OECD guidelines for multinational enterprises, and you can look to the Sustainable Development Goals as well. I think beneath the international normative standards, you also then have all of the more specific initiatives that are equally important in terms of building tools for corporates and investors to use. So everything around palm oil sourcing, around soy sourcing, tea sourcing, specific guidelines for the garment industry. Over the last 20, 30 years, there have been a lot of developments on that front that are helping companies to move in a more sustainable direction. And I think I'll just close on this slide by really emphasizing the opportunity angle here. If collectively and over time and collaboratively, we can find ways to make global supply chains more sustainable as well as efficient and resilient, the impact there for stakeholders, the potential impact is absolutely huge. And I think that's why there's increased attention on that in the current context. If we can jump to the next slide, I just wanted to show at a high level the visual iris perspective when it comes to sustainability assessments. Sorry, could we move forward? So what do we actually look for? What does supply chain sustainability look like? And I think it's important to note that there are at least 3 dimensions that we would be examining in the course of our work. You have firstly kind of the contractual relations with suppliers. And here we're looking at issues around fair contracts and the prompt payment of suppliers. And in the context of COVID, with many corporations really looking to protect their treasuries and make sure that they're not spending too much too quickly in an uncertain time, we have certainly seen a rise in the number of controversies related to late payments of suppliers and issues like that. The second angle, I think, is the one that people are more familiar with, and that's everything around labor standards and supply chains. So the respect of employee well-being and fundamental rights. This is an area where we continually see controversies and where there is the most stakeholder attention. And obviously this raises reputational risks for corporates and investors. And the final angle, I think, is one that is still developing in terms of maturity, at least from a corporate approach perspective, and that is environmental risk management in the supply chain. There is more information coming out year by year about the size of the indirect environmental footprints that companies have. And it's becoming increasingly urgent that companies build policies that address their direct operational impacts, as well as the environmental impacts in their supply chains. And that really takes me over to my final slide. So if we can move forward one more. I just want to close by talking very quickly about supply chain controversies, because this is often what triggers attention and starts debates around social risk and supply chains more specifically. It's important to note that these can take place anywhere. And for anyone on the line familiar with the Boohoo scandal this year, that's the perfect example where you had a company with major supply chain challenges located right here in the UK. That being said, many of the highest profile ESG controversies in recent years have certainly been located in the APAC region. We can go back to Foxconn back in 2010. We can talk about Rana Plaza in Bangladesh more recently. There are plenty of examples there. And I think the lesson for corporates is that whilst you may be creating stakeholder risk, sustainability risk in other parts of the world away from where your headquarters are, the operational and increasingly reputational risk and the pressure from investors for you to account for and report on how you are seeking to address those challenges, that is something that is certainly rising. So to close out my remarks, ESG challenges related to supply chains, they're old news. And if anything, COVID-19 has simply raised the pressure and increased the volume at which people are demanding action. For companies, they face some pressure to bring production home or closer to home. And in some sectors that may be possible. You can think of manufacturing, for example. But in other areas like agriculture, I think of palm oil sourcing and tea, that's going to be very, very unlikely for obvious reasons, right? It is hard to grow coconuts in Iceland. That is not something that will happen. And so the challenge for corporations globally will be to collaborate to ensure efficiency, to ensure resilience and sustainability, regardless of where they are operating and where their suppliers are based. So I'll close there and then hand over to Rahul for the next set of remarks. Thank you.
Icelandic coconuts, that's a great segue, I think, to what I'm going to discuss. Hello, everyone. Thank you to the AVPN for putting this on. My name's Rahul. I'm a Senior Vice President in Moody's Investor Service, which is the credit rating agency arm of Moody's. And I focus on emerging markets. And it's a real pleasure to be participating on this panel with members of the Moody's family and with yourself. I'm going to take a slightly different approach to the discussion. I'm going to really look through a macro lens at supply chain issues and why they matter from a credit perspective. And if I could leave you with one takeaway before I get into my remarks, it's that supply chain management, and in fact ESG more generally, matters not just in terms of creating sustainable value or managing reputational risk. Of course, those things are important. But increasingly in our analysis, we see that it matters from a credit perspective in terms of mitigating investment risk and in terms of deriving investment value as well. And hopefully what I show you today will speak through some of those issues. But I think actually where I want to start is just take a pause and think about just how much of a crisis we've seen from this pandemic this year from an economic perspective. I think for all of us, the pace of events this year has been so quick. It's often just important to take a step back and think about how deep a downturn that we've already seen. So Just to put a few stats there, G20 real GDP growth in the second quarter this year fell by a record 6.9% Q on Q. So that's the largest, steepest downfall we've seen on record. And in fact, if I think about just world trade volumes fell 16% between just February and March on the back of a virtual shutdown in the global economy, business closures, supply chain disruptions, and social distancing. And global crude oil prices, perhaps this is a good thing long term, but also fell to an 18-year low of $19 per barrel. So really steep decline. Now, of course, if we look forward, there are signs that an incipient recovery are already underway. But our view at Moody's is that this crisis is going to leave a lasting imprint on the way that our global economies, our financial systems, and our societies operate. And if I could just take you to the next slide. What you can see here is some of the key themes. Sorry, just the next one after. What you can see here are some of the key themes where we think that the coronavirus crisis will shape broad credit trends over the coming years. I won't go through all of these, and hopefully you'll see the slides later, but I think there are two key points to make. The first is what you can see here, whether it's weaker growth prospects, shifting political climates, it's really a case of the coronavirus pandemic accelerating, perhaps reinforcing existing trends that we've seen start to gain traction over recent years. And I'd say the other important point is that ESG sort of flows through many of these issues, not just obviously the rising ESG focus that Anna's talked about earlier in terms of increasing recognition of risks by the international and institutional investment community, but also when I think about tech disruption, I think about the shifting political climate, clearly key ESG undertones, and the area that I'm going to focus on today as well, which is supply chain and global trade fragmentation. Kieran touched on this earlier, but I think one of the key trends that we see, and this is really, as I mentioned, an accelerant rather than a fresh trend, is a more splintered, perhaps a gradually more protectionist global economy. We think that trend is going to gain speed, and that's going to lead to some important trends around regionalization versus globalization, potential restrictions on trade, investment, and technology transfers as well. Obviously, in talking about that story, I think it's important to talk about China, and in fact the rise of China that we've seen as an important supplier of the global economy over the last couple of decades. So just to put some context around that, China accounts for just shy of 20% of manufacturing exports today, and it was only 4% around 2 decades ago. So a real shift in a relatively short space of time that we've seen in our global manufacturing supply chain. And of course, that can lead to disruption. And we saw that back in March, of course, where we saw supply chain disruptions in China lead to a virtual breakdown in manufacturing activity across our global supply chain. And this really, I think, for many governments, for many investors, and of course for many companies, highlighted the reliance on a just-in-time model. And I think there's likely to be a bit of a shift in mindset going forward. So how do we think some of these trends are going to play out in practice? If we can turn to the next slide, what we've sort of put here is a bit of a flow diagram in terms of how we think from an economic perspective we might start to see a recasting of global supply chains. I think the first thing to note is that there is an increased focus on supply chain robustness and supply chain security, both amongst governments, but also non-governmental actors as well. So what do we mean by supply chain robustness? We mean the ability to maintain your operations during an unforeseen crisis, and that can be achieved by either increasing your inventories or looking at where you get your supplies from. Supply security in particular is ensuring that you have a robust supply of goods and services from strategically important sectors. So we're thinking here, clearly medical supplies and medicines have been in the spotlight in this crisis, but also security around sort of staple foods, around defense and military, electronic and electrical parts, energy. These are all important areas that companies are going to be giving greater focus for in terms of supply security. I think another area is, of course, less reliance on a single supplier, or in economic jargon, reducing your concentration risk. And again, this is not a new trend, but one that has really seen increasing focus post-COVID. And of course, that sort of relates to the China issue as well. So China accounts for around 20% of total machinery imports today for the US, and it can be higher, around 40% for the likes of other major economies like the EU, Japan, and Korea. And we saw during the crisis, the likes of, just to give you some examples, Hyundai, Fiat Chrysler, Nissan, all saw their operations affected by some of the disruptions that we saw in China. So what does this mean for our global supply chain going forward? It means that we're going to probably be less efficient. We're probably going to be less a sort of just-in-time supply chain model. And there's going to be an increased regional focus, more focus on diversity as well going forward, more focus on supply stock, on inventories. And I think global companies are probably going to sort of introduce two strategies. One will be thinking about the diversification of supplies. The other will be around localization, reshoring, or if not reshoring, nearshoring of some of their production, particularly in strategic industries. So I want to finish by talking about what this might mean for Asia in terms of this recasting of global supply chains. And I think broadly speaking, many Asian economies do stand to benefit from some of these underlying trends that we're seeing on supply chain diversification. And of course, US-China trade tensions that we've seen in recent years does play into that equation as well. We think that corporates will be looking at markets with sound operating environments, good investment climates, with strong manufacturing production capacity, high export substitutability with China, deep labor pools, and of course fewer geopolitical risks as well. That's all going to come into the calculus when thinking about future investment flows. And to that extent, we think that countries like Thailand, Vietnam, Taiwan, Malaysia, are all well placed on many of those metrics. And of course, this isn't a new strategy. We've seen for a number of years, companies have been setting up facilities in neighboring countries beyond China. The sort of China +1 strategy has been in play for many foreign manufacturers in recent years. If we can just go to the next slide, I just want to give a case study for the ASEAN region. So that's Southeast Asia. We do think, as I mentioned, the likes of Thailand, Vietnam, Malaysia could stand to benefit. One of the challenges will be reshoring. So as the US, the Euro area start to think about a more localized supply chain machinery. So what would that mean for countries in ASEAN, for instance? And we think there are a number of mitigants that they could think about. Firstly, try and enhance free trade agreements with advanced economies. But of course, that on the one hand, that will give incentives for multinationals to retain productive capacity. But in the current climate, free trade agreements are politically challenging. I think the other area is deepening regional trade agreements. You can see I've highlighted a couple of examples here of proposals such as the Regional Comprehensive Economic Partnership, of course, TPP as well, the Comprehensive and Progressive Agreement for the Trans-Pacific Partnership as well. And of course, ASEAN is a huge bloc, so it could try and develop its own regional economic integration as well and take advantage of its own growing consumer middle class. I think to a certain extent, all of these strategies will be adopted by companies and countries within Southeast Asia. And I think just to come full circle on some of these trends, as I mentioned, we are going to see a more fragmented global trade system going forward. Of course, China will retain significant prominence in that, but we are going to see some diversification on the back of underlying motivations like supply security and concentration risk. And I think just to come back to Kieran and Anna's points at the beginning, as we see these sort of broad macro trends play out, we are going to see an increasing focus amongst companies when considering markets to invest in and when considering companies to partner with, an increasing focus on how prepared are companies for unforeseen shocks in their risk management, in how they're dealing with social and environmental issues in their supply chain. And bringing it back to credit, we do think that companies that are perhaps constrained or do show a lack of preparedness, perhaps they're not signatories to some of the agreements that we've already discussed, they may over time find it more difficult to raise or perhaps refinance debt in the capital markets, given the increasing focus that institutional fixed income investors and broader investors are placing on ESG risk and resilience. So hopefully that gives you a bit of a flavor of the macro view and how that is aligned with this discussion. But with that, I'll hand back to Martina.
Fantastic. Thank you, Rahul, Kieran and Anna, for these very insightful presentations and very different perspectives on some of the risks, opportunities, challenges on the trajectory towards resilience, and clearly social resilience, supply chain management oversight at the heart of this journey. May I ask participants here on the webinar, and sorry for not highlighting this earlier, please share your questions. There is a Q&A button at the bottom line of your screen. If you have questions, maybe either aimed directly at some of the presenters or more generally, please send them, share them with us, and I will bring them back into the discussion while kickstarting this brief Q&A. Maybe Anna, if I may start with you, would you be able to highlight how COVID-19 again has really impacted the sustainable finance market?
Sure. Thanks, Martina. Well, I touched a little bit on this idea that post-pandemic, the trends that we had before really intensified. And if I could go back to that slide, I would, but hopefully participants get the slide deck afterwards. But I think one of the shifts that we've seen is just the sort of topics that became important post-pandemic. I would say that before COVID, right, sustainability conversation revolved a lot around environmental factors, and particularly around climate. And those are obviously critical, but I think social really rose in prominence now after the pandemic. So there's a lot more conversation about things like health and safety, diversity in the workforce, and so on. And we see it even reflected in the sustainable bond market. So the labeled bond markets that include green social sustainability bonds. We really saw kind of reshuffling and a greater proportion of those instruments labeled as social or sustainability. And that's because there's an increasing focus on social projects or projects with social benefits post-COVID-19.
Very interesting. Kieran, sorry.
No, that's that.
Sorry. Thank you. Kieran, a quick question. In addition to what Anna just highlighted and the transition towards social risks and opportunities, how does it play out in the context of operational resilience, and ultimately, how does VE again highlight, assess, see areas of social risk? You highlighted the supply chain management context. You highlighted the normative and potentially there are also regulatory frameworks now when we look at S&G. But could you give us a bit more of a perspective again on how VE is advancing operational resilience and the assessments of that or in that context?
Absolutely. So thanks, Martina. So in terms of the question, I'll break it into, I'll talk about assessing, I'll talk about advancing. When it comes to assessing, I mean, social analysis and the analysis of social factors, that is embedded into every sustainability rating that we produce on companies, on local authorities, and on sovereigns. It's fixed into the cake recipe, as it were. And we really try as much as possible to provide a good dialogue between the companies that we're assessing and our analysts so that they can understand what it is precisely we're looking for and why we are looking for it. And then also upwards to the investors that use our research so they can understand why this is of use to them. What are the kinds of risks that this information, this data can help them to track and to manage over time. There are a number of trends that we've picked up over time. The first one is whilst we are talking about social risk this year in 2020, that hasn't been the case for the last decade. And I think one of the interesting and slightly dispiriting pieces of data that we can track is the approach to companies on reorganizations. So we've followed this from the 2008 crash, where we faced the global crisis in terms of workforce redundancies, to today, where we face effectively the same pattern again. And the pattern in terms of disclosure and in terms of really providing assurance to different participants that this is being actively managed is very, very low. And so as we enter now this new period of global reorganizations, there's very little evidence, I think, at the macro level to suggest that there is a strong handle on this at a corporate level, and that is a concern. Now, in terms of how we more proactively advance the management of social risk and the impact, we do a lot of work providing second-party opinions on sustainability bonds and sustainability loans. And this year, we've really seen a rise in social bond issuance, really as a reaction to the gravity of the crises that many different sovereigns and many different companies have to face. To give you a flavor, only last week, we supported the issuance of the Mexican government in the first sovereign SDG bonds. We also supported the French social security system in refinancing their social security system as well. And so those are kind of more proactive ways in which we provide an opinion on the issuance itself, how it will advance social objectives. And absolutely, that's a pattern, a trend that is on the rise in 2020.
Thanks a lot for that, Kiran. Staying on that assessment trail, Rahul, from the MIS, the credit ratings perspective, could you again briefly highlight or re-highlight how MIS assesses systemic social risks and implications in the context of an issuer's creditworthiness?
Yeah, of course, Martina. Thanks for the question. Happy to. So, yeah, as a credit rating agency, we have a slightly different objective when we're looking at ESG. It really is to think about how can a company or a bank or a government's ESG exposures impact its credit risk. So in other words, its willingness and ability to repay its debts in full and on time. And so, you know, from a credit perspective, that sort of concept of financial materiality, in particular credit materiality, is very important to us. I think one of the challenges with social issues, and Kiran sort of touched on this earlier, is they are without doubt the broadest element of ESG sort of credit analysis. Impacts on credit quality can be complex, they can be interrelated, multifaceted, and varied. So it is challenging. And of course, the social considerations we look at for private sector entities like, you know, companies and banks and infrastructure, for instance, it is somewhat different to what we might look at a government level, for instance. But putting that to one side, what we've done last year is, in fact, a couple of years ago now, we looked at our entire rated portfolio of outstanding rating debt. So that is just shy of $78 trillion of rated debt across 82 sectors globally. And what we found based on this analysis, a sort of bottom-up analysis with our analytical groups, is that of the $78 trillion of debt that we looked at, there was around 14 sectors that you can see on the screen here with $8.3 trillion in rated debt, where we saw high credit risks from social issues in those sectors. And actually, something that's quite interesting there is that number is higher than environmental risks, where we only saw around $2 trillion of elevated risk. So this tells us that conceptually social risk matters. And in fact, when we did a study of our rating actions last year, we found that social issues were material for 20% of rating actions that we looked at last year. And of course, that number is only going to increase for 2020, given the impact of coronavirus.
Thanks a lot for the details. I think there are a few more questions coming in, Rahul. May I start again right with you? There was a question around explaining the concept of reshoring a bit more, if that's okay with you.
Absolutely. Yeah, apologies. I should have explained some of the terminology. So I'll keep it very quick. So reshoring is the idea of bringing back productive capacity from a different country back to the home country. We think that trend is going to be partly driven by concerns over supply security, but of course there are many other dynamics as well. Political risks and sort of nationalist policies, for instance, have driven a lot of that discussion, particularly in the US, for instance. We also think that automation will be a big trend that facilitates reshoring, as well as we start to see the use of greater use of robotics in automotives, for instance, as well. So that's what we mean when we talk about reshoring.
Thank you very much. Anna, quick question for you. Someone is asking the question around what should or could traditional energy companies take to deliver towards or on their ESG goals?
Thanks, Martina. It's a great question. I mean, specific actions, I suppose, would depend on the energy company, but I will broadly say that, there has been a lot of conversation around including heavy emitting industries in sustainability conversation. I think over the few years past, let's say if we look at labeled bond market, such as a green label, we mostly saw companies come to the green bond market that come from business models or have business models that are traditionally viewed as green, say renewable energy or green buildings. But there is just increasing recognition that we do need a broader conversation that encompasses heavy emitting industries as well. If we were to achieve a low carbon future, it needs to be an economy-wide transition. Obviously heavy emitting industries are the ones responsible for most of the carbon emissions. So there's sort of this development and a conversation in the market around how to include them. I will mention, for example, there's a talk about a transition label, and we've seen companies come to the market with bonds that are labeled either transition or something similar. And that kind of label is designed to include heavy emitters in a sustainability conversation and provide a way for them to communicate their sustainability strategy to the market. We don't have a lot of standards, so we don't have any standards really right now around what qualifies for a transition label, but there is a conversation. A white paper recently came out from help me out here. Yeah, okay, I'll get back to that. But there's a recent white paper on what transition standards, what would qualify as a credible transition for an energy company. And I think at a broad level, there is a sense that there should be an alignment of a broader business model and broad strategy with a credible transition pathway towards low carbon future, such as Paris Agreement goals. I'll mention briefly the sustainability linked bonds, for example. Sustainability linked transactions speak not to specific projects, but really to broader goals that heavy emitting industries can have that align them with a low carbon pathway. So that would be my broad view on how energy companies can participate in the conversation. Hopefully that helps.
Fantastic. Thank you very much, Anna. And clearly the energy companies and the entire sector related to these sort of issues have a key role to play in the transition. We started with a just transition. We should highlight it all kick-started somewhere with a green and global transition. So now we are connecting the dots between E and S, and exactly that's what we're trying to highlight here as well. Thank you for this. I think we have maybe one quick question still here, Rahul, if you're able to answer this, and then I will quickly conclude and hand back over to Gloria and the team. Last question here, what is the adoption rate amongst investors at the moment of sustainable practice within companies' supply chains relevant to credit risk? I think you highlighted a couple of the examples, but maybe just to restate and reiterate.
Yeah, so if I understand the question correctly, it is how much are investors thinking about sustainable practice within their credit analysis? Particularly on supply chain. So the answer to that very briefly is I still think it's pretty early days. We are seeing obviously increasing signatory support. The PRI, the UN Principles for Responsible Investment, I think has around $86 trillion of assets under management that are signatories. and are committed to integrating ESG issues into their investment decisions. I think there are two elements to this, and I'm going to ask Kieran to give his thoughts on one of them in a moment, but there's engagement and data, right? So on the engagement side, we are seeing even fixed income investors, it's traditionally been more on the equity side, increasing engagement with investee companies. And that can have a material difference. So Kieran mentioned the Rana Plaza disaster earlier. Because of that, sad, tragic events, we now have the Bangladesh Investor Initiative, for instance, and we're having increasing focus on thinking around supply chain in textiles. On the data side, I still think there's a lot more room to go. We've mentioned climate data with the TCFD sort of increasing the focus there. There's talk about natural capital data. I do think that consistent, transparent data around supply chains, particularly in my area, which is emerging markets, is still a challenge that hopefully the likes of Kieran and Vijayaris and others can look to take on, but I think will require an increasing focus on standards as well. I'm not sure, Kieran, if you wanted to add anything there.
Yeah, sure. I mean, very quickly, I'm ever the optimist, and when I think about how far we've come with climate disclosures in a short period of time, and when I bear in mind that certainly within the frame of the European Union, we've come up with a green taxonomy that is going to be rolled out, that is controversial, but that does move us forward. There's no reason to believe that with collaboration between different market participants, a taxonomy on social issues and stronger reporting frameworks for all social issues, including supply chain, that should be within our grasp as well. So if we maintain the urgency of the moment and tap into these great institutions that now exist to try and forward these mechanisms, that's definitely something that is within grasp.
Fantastic, and thanks Rahul for bringing Kieran in, because that question really speaks to the great assessment methodology / the work that Kieran highlighted and outlined earlier. And that brings me to a minute here of concluding remarks, and I would like to kickstart this with some observations from today how key messages are concerned. Up and foremost, global standards, as Kieran and Rahul and Anna all have highlighted, have a key role to play to mitigate reputational operational risks and potentially prevent certain or address certain controversies and build social and ESG resilience over the longer term. We've heard that we see shifts in global supply chains and economic activities, and that we see that there's a focus on supply chain security and robustness, and a reduction of concentration. A more regional network of supply chain or supply chains might be the outcome. Investors, again, in turn, have also a key role to play when and where strategies for mitigation and adaptation in global supply chains, in global operations are concerned. And essentially, ultimately, this crisis has put the stakeholder model of capitalism to the test, as Anna has highlighted. COVID-19 has emerged as a test case for a multi-stakeholder collaboration model on social issues and environmental issues, with challenging trade-off decisions between business strategy, employment continuity, and worker health. And it is increasingly seen as a prerequisite, but remains difficult to define, let alone to measure, when and where social dimensions and ultimately metrics are concerned. That in turn, again, leads us to the conclusion that we need profound and trusted social and governance data sets and ultimately dedicated financial instruments. With these few words here at the end, I'm handing over to Gloria and would like to thank you all at AVPN for this opportunity.
Thank you so much, Martina, and thank you to our esteemed speakers, Anna, Rahul, and Kieran. We greatly appreciate the insightful and passionate discussion about ESG risk resilience and best practices that the audience is going to take away. Thank you all for joining us today. You will see a link for some upcoming AVPN webinars. For next Wednesday on September 30th, we will be hosting a webinar co-organized with UNDP on strengthening the capability of governments to engage philanthropic capital during COVID-19. On Friday, October 2nd, we'll be hosting a webinar on integrating impact and financial returns across your portfolio. If you would like to register for these events, please see the registration links in the Zoom chat. And we look forward to seeing you back here again. Until next time, have a good night, good day, and goodbye. Thank you, everyone. Thank you so much for joining us.